I often get questions about long-term investing. Why don't I just buy a basket of stocks and hold on to them for 25 years? After all, that's a great way to make money, right? Well, not so fast. There's some things that you need to know about investing truly for the long term and the things that can actually hurt your performance. The most valuable commodity that any investor has is time. And when we lose time in terms of, well, losing money in the markets and having to make it back up, those are years or months or quarters that we never get back. After the turn of the century, investors went through two major bear markets. The first was a 50% loss in the markets due to the crash of dot-com stocks. The second was another 50% reduction in portfolio values following the financial crash in 2008. Unfortunately, for far too many Americans, they're going to run out of time trying to save and invest for their retirement goals due to the impact of the losses that were created during the bear market declines in both those periods. The problem is that many of us don't realize the risk of losing capital when things go wrong. The understanding, which has been lost by many individuals in recent years, particularly when it comes to investing, is that the goal of investing is to ensure that our savings maintain their purchasing power parity in the future. In other words, it maintains the buying power today into the future. But the problem for many individuals is that we lose the fact that we are simply speculating in the markets, hoping that we're going to get a higher price in the future. But that's not always the case. I've never understood the rationale when people tell me they have to be invested in the markets. That's not actually the case, particularly when we're taking risk with the capital that we're investing. There's an old adage that says if you're sitting around a poker table and don't know who the pigeon is, it's probably you. The most basic investment rule is simply this: buy low and sell high. It is the only way that money is actually created within the investment process. Unfortunately, that's the one rule that is most often ignored by investors who typically buy high and sell low, destroying the entire investment process.
You blew it!
But of course, that is simply human nature at work. It's when we're feeling most greedy that we tend to buy, and that happens at late stages of bull markets, and we're most fearful when we sell, which typically occurs at the bottom of a bear market. But investing is simply about the function of math. Let me show you this example. Let's assume you want to maintain an annualized rate of return of 10% annually over the next 5 years. Here are the hypothetical market returns over the next 5 years. Plus 10% the first year, 10% the second year, and 10% the third year, giving you an annualized rate of return for the first 3 years of 10%. But in the fourth year, you lose 10% on your money. Now here's the important point to consider by looking at this table. What you find is that there is a dramatic impact on the value of your investment portfolio over that time. And in fact, by the end of the fifth year, your total compounded annual return falls by more than 50%. That's the impact of drawdowns on your investment portfolio and why maintaining principal is so incredibly important. This next chart illustrates the same thing much more clearly. The first graph shows what the expected total annual rate of return is at 10% a year versus what really happens with just a 1-year loss of just 10%. Can you imagine what happens to your portfolio if you lose 20 or 30 or 40% as we have in the past? It happened then, it will happen again in the future. So this brings us back to the very basics of long-term investing. Sure, could I buy a basket of stocks and hold them for 25 years? Absolutely, and you would probably be okay. But as this next chart illustrates for you, and I'll show you here, let's assume that we invest into the markets and we average in $100 a month. Let's do dollar cost averaging along the way as well. What this first chart shows you is the growth of your money over 25 years using real market returns and $100 a month in dollar cost averaging. But what if I do exactly the same thing, but this time simply just hold my cash during market drawdowns and wait to reinvest those savings into the market when I'm buying low or valuations are cheap? As you can see, there's a dramatic difference into the total outcome, and the difference is whether I retire or not. If you want to succeed at long-term investing, there's 8 things you need to know. Investing is not a competition. There's no prizes for winning, but there are severe penalties for losing. Secondly, emotions have no place in investing. You're generally better off doing the opposite of what you feel like you should do and do more of what is working and less of what's not. 3, the only investments that you can truly buy and hold are those that provide both an income stream and, most importantly, a return of principal at some point in the future. That includes CDs and bonds. 4th, it is often said that market timing is impossible, and I absolutely agree with that. Trying to time the entries and exits from markets on a consistent basis is extremely difficult, if not impossible, to do consistently. But what you can do is manage risk and avoid the times when risk outweighs the potential for reward. 5th, investing is about patience and discipline. The most important thing about investing is staying true to your discipline and understanding what your discipline actually is. Most investors put money into the markets without a real understanding of how it's supposed to actually work. Number 6, turn off the television. Too much media, too much bias is leading you to make emotional decisions that affect your long-term investment outcomes. 7th, investing and gambling are both about controlling risk. No professional gambler ever walks to the table and bets all in every single hand. They understand that when their risk of losing outweigh their chances of winning, they take their money off the table. Investing is no different. And lastly, no investment strategy works all the time. The trick is knowing the difference between a bad investment strategy and the one that is temporarily out of favor. As an investment manager, I'm neither bullish or bearish. My job is very simple. It's simply to manage money, to create growth over time, and take as little risk as possible doing it. If I protect the capital in the short term, the long-term returns will take care of themselves. For more on investing and investing rules and guidance like this and more, simply go by our website at realinvestmentadvice.com. That's realinvestmentadvice.com. I'm your host, Lance Roberts. Thanks a lot.